So yeah, it's a pleasure to host this panel. As many of you may know, it's a subject that I'm personally very passionate about and really looking forward to a lively discussion. Because we have limited time, I'm just going to breeze through the intros. If you don't know the panelists on stage, then you should get to know them because these are the most important players in this industry. HUD 8 is the sponsor of this panel, so I will briefly introduce HUD 8. They are North America's oldest and largest innovation-focused one of North America's largest digital asset miners, supporting open and decentralized systems since 2018. They're located in energy-rich Alberta, Canada, and HUD 8 has one of the highest installed capacity rates in the industry and holds more self-mined Bitcoin than any miner or publicly traded company globally. So I wanted to start the panel actually to discuss the markets, and I thought it would be perfect to start with you, Jaime, given that you're listed started with your listing in Canada. So currently public listings of crypto miners are almost exclusively concentrated in North American exchanges, TSX in Canada, NASDAQ in the US. What makes these exchanges draw miner listings? And going forward, do you expect miners to potentially target more global exchanges or to remain North American dominated?
Yeah, it's a great question and something that's that I kind of tackled head on when I took over HUD 8 earlier this year, or actually December 1st of last year. We were exclusively trading on the Toronto Stock Exchange, and really what we saw was just not the access to liquidity that our peers like Fred were experiencing on the NASDAQ. And ultimately, that's what drove us to move to a dual listing and now being on the NASDAQ as well as the TSX. We've seen a very, very significant increase in liquidity. It's given us access to a much larger investor pool, and it's certainly proven out our thesis very, very quickly.
And Fred, if you wouldn't mind sharing us a little bit about your journey through listing and how the company has evolved since the time of listing.
Sure. So Marathon has existed as a public company through a number of iterations. So it was originally founded to actually exploit vanadium mining way back in the day, and then went into oil and gas leases, changed shareholder groups, became a patent troll, Marathon Patent Group. And then in 2017, there was a regime shift. Mariko Komodo became CEO. I joined the board in early 2018 with a focus on really developing a Bitcoin mining business. Problem was the company had a market cap of about $4 million. It had a lot of debt, so we had to clean all that up. And then over the course of really late 2018, 2019, and into 2020, raised $500 million of capital through the public markets, and then essentially placed a very big bet in 2020 and ordered a huge amount of miners from Bitmain, really to kind of, with the belief that the cycle was going to do what the cycle has done. So kind of opportunity met preparation, I guess you could say. The public markets responded very well to that news and continued to grow our valuation. And today, I think we're around $4.25 billion market cap. Stock's been performing really well. The price of Bitcoin certainly helps it. We're very correlated, obviously. I think, in difference to some of the other miners, we just mine Bitcoin. We don't operate kind of hosting. We don't do third-party hosting for other people. So we're very much a pure play proxy for Bitcoin. That's the business we've chosen to be in. And we think that this is a very capital-intensive business. Today, it costs about $60 million to deploy or to acquire 1 exahash of compute power. That doesn't include deployment cost. If you look at the growth in the global hash rate, that same amount of Bitcoin production, 1 exahash today, gets you about 6 Bitcoin. Next year, it'll only get you 3 Bitcoin because the global hash rate's going to double because of all the miners we're deploying, plus all the other people coming into the business, all the power companies coming into this business. The end of 2023, it'll be 2 Bitcoin for an exahash. And then you have a halving in 2024, so you'll get less than a Bitcoin. What that really means is that $60 million today will be $480 million in 4 years. You have to be very well capitalized to be in this business.
So Now, we talked about the U.S. and Canada, and I know that Mike, you're in a process that will likely see you listed in the U.S. in the near future, and we'll get on to the SPAC process and why that's been a popular route to the markets in a moment. But before we get to that, do you see merits in listing in other international markets, either primary or secondary listings for mining companies?
The short answer is yes, and to get to the point that both Fred and Jamie made, right? You list because you seek liquidity for your investors. You list because you want access to capital, and you list because you want a currency. Popular term this morning, I mean it in a different way, a currency for consolidation, for acquisitions, for doing business. And the principal reason that we all are listed in the United States is, right, it provides the market that is the strongest and broadest and deepest in all those respects. But that said, we're in a business that is clearly, all right, global, and is clearly expanding rapidly. And if you look at those as your objectives, it makes a lot of sense for us to be closer to other markets to achieve all three of those objectives. So we certainly hope that once we're listed, hopefully next month in the U.S., we'll then, over the course of time, explore potential listings elsewhere.
Now, Amanda, you work with a number of both public and private miners, and we've seen access to cheaper capital becoming available as an incentive for public listings. Now, there's obviously a cost of capital gap between private and public companies in general, but it seems in the Bitcoin and mining industry, this is more pronounced, significantly more pronounced than you would see in many other industries. Why is that the case? Is that the result of the industry's nascency? Do you expect this characteristic to persist, or do you think the cost of capital for private miners will come down eventually as well?
I think a lot of that has to do with just how people interpret the industry. So Bitcoin is difficult to get your head around to begin with, and then mining is one step below that. So when you're thinking about investing in something, you have to understand what you're investing in. So I think traditionally it's been really difficult for private companies to raise. That has completely really shifted this year. So we've seen a lot of private companies raise a ton of capital for mining. And the reason why they need all that capital is to Fred's point, right? It's capital intensive business. So I think sometimes that has been a barrier to entry, both on it being highly capitalized and then also the educational proponent of it. So I think when we think about all the different companies that are out there and even the public mining companies, it's really difficult to compare one to another, right? Because there's no industry standards yet. So we all share certain things, right? We share how much hash rate we have, how much hash rate we're projecting, our cost to mine a coin, but that's really all, how we're calculating all of those things can be different on the back end. So I think once we set more industry standards, right, that maybe it will be easier to get more capital inflow into both. But we are seeing more capital flow into it, and I think that's because people are seeing Bitcoin mining as a lot of different plays. You can see it as an infrastructure play. You can see it as a way to get access to Bitcoin if you can't hold Bitcoin on your balance sheet. You can see it as a way different companies getting into it, like insurance companies, or large traditional companies seeing it as a way to provide financing. So I think that there's a lot of reasons why people are now starting to look into mining, but there's still that educational piece and the lack of industry standards that we're all working hard to push towards.
Now, you highlighted the fact that mining is effectively a layer more complicated than understanding Bitcoin. You should really understand Bitcoin and be comfortable investing in Bitcoin before you're comfortable investing in mining. But one thing that we've seen with investors and institutional investors is that with mining, they have comps. They have something that they can price. They have an EBITDA. And that's something that we've seen actually makes them more comfortable buying a mining company than actually buying Bitcoin. I see nodding heads, so I assume that is the case. But Jaime, I'd love to see what your experience has been in that regard.
Well, that was the entire thesis behind Hut 8 starting when it did in early 2018. It started as really an opportunity to give a proxy to Bitcoin, but as a traditional equity. It's also why we've been hodlers of Bitcoin since inception. It's to give the investors exposure to the upside of the mining operations, as well as the appreciation of the asset as we hold it on our balance sheet. And really, I see investors more and more looking at miners as an alpha play.
And so that's an interesting point. And we've seen, obviously, we just had sponsors of major ETFs and closed-ended fund products that were able to achieve listing only last year on major markets. But miners have been listed for some time before that and have had actually a lot more ease working with regulators and understanding their businesses. So, Fred, if you wouldn't mind sharing why regulators seem to prefer or are happy with miners listing on their markets, but have had so many challenges around ETFs, closed-ended funds, particularly in the United States.
Well, I think it comes down to risk mitigation. Regulators are there to protect consumers and investors. A mining company is essentially a data center operator that happens to generate their form of payment, if you would, for doing what they do, or Bitcoin, and then they either hold or they sell their Bitcoin. We're not issuing currencies, we're not taking deposits, we're not doing anything that is really covered by any regulation. We're just a data center operator at the end of the day. You can look at it that way, and a deployer of capital. Over time, because companies like Hut 8, ourselves, and many other miners hold all our Bitcoin, we start becoming financial institutions potentially because we end up sitting on this huge pile of Bitcoin. That's a different story. That'll be something the regulators may or may not deal with in the future. But essentially, we are printing presses for money. And as Warren Buffett famously said, I don't buy gold, I invest in Rio Tinto. It's the same thing. If you invest in a Bitcoin miner, you get that whole gross profit cash flow, if you would. And for most of the bigger Bitcoin miners, it costs somewhere between $5,000 to $7,000 to mine a Bitcoin. A Bitcoin at $57,000, there's a lot of margin in this business. So it's a very profitable business. And at the same time, if you hold your Bitcoin, for example, we even went into the market in January and bought $150 million of Bitcoin at an average price of $30,000. Well, that's almost doubled in value now. So as asset managers, we have a base value, if you would, which is what our holdings are, plus all our infrastructure, and then the cash flows that we generate, the notional cash flows, because we don't sell our Bitcoin. But essentially, when you think about it, the alpha in a miner, and I'll use our stock as an example, Bitcoin went up 3% yesterday, our stock went up almost 9%. When Bitcoin goes down 5%, we typically only go down about 5%. So if you look at the bigger scale miners, we provide better alpha than Bitcoin with much better liquidity, without the risk. It's an easier play for investors.
Now, one of the trends globally across industries in converging the cost of capital between public markets and private markets has been the rise of SPACs. These have become a common path and a popular instrument for the path to public markets for miners. Mike, if you wouldn't mind sharing with us what is driving this trend.
At least in the looking back, the trend actually has to do with SPACs are a more friendly vehicle for, frankly, those companies that the big underwriting banks don't want to take public. And so SPACs have been used to take mere business plans public. And in the case of Bitcoin miners, if one were to have asked Goldman Sachs, JP Morgan, Morgan Stanley, et cetera, earlier this year, which I did, would you be interested in doing an underwritten IPO for our company? The response was, we know you and love you, Mike, but no. We're not going to be able to get a Bitcoin-related company of any sort through our commitment committee. Mm-hmm. Pure and simple. the utilization of a SPAC for us and for some other companies is quite simply a means to get public, right? There's 4 ways to really go public, right? You can reverse merge into a shell company, kind of tough to find the right shell, and there's sort of costs associated with that. You can go public in an underwritten IPO, flat out not available first half of this year. I actually think that with this gradual institutional acceptance of the companies, the asset class, et cetera, that would happen today, right? You can do a direct listing, but that's really much more appropriate for consumer-facing businesses, or use a SPAC. And so in the case of us and many other companies, the SPAC it's really access to becoming a public market, because I want to be like Fred and Jaime, right? We want to be like these guys.
Thanks, Mike.
You got to have goals in life, right? And so that's really, it's a practical need, and the SPAC fills that practical need. Probably for another panel, I can talk about SPACs and their utilization and appropriateness, but for now, just look at it as a good way for companies like us to get public.
Well, if you wouldn't mind, if I could just ask very briefly around some of the unique challenges around a SPAC process and how maybe those are looked at differently as a miner, particularly around the proxy solicitation process and the amount of leakage that SPACs have versus traditional offerings.
So in our case, and I would say in many cases, it's simply a function of cost, right? So if you go public in a classic IPO, you're going to pay, let's say, 6% on your capital. If you go public in the context of a SPAC, it's going to cost you 10% of capital raised. And that's really it. Otherwise, you file an S4 registration statement instead of an S1 registration statement. They're virtually identical. It's an SEC overseen process. We were talking about earlier, why is it that companies like ours are able to we fit the SEC model really well. We're real companies with real revenue and real cash flow that in fact can be audited and accounted for by big 3 firms, right? So the process is a little more expensive. The leakage is a little greater. But that said, otherwise, not all that different. One other issue is you set the value well in advance of the day you price. And that can be good or it can be a challenge, right? One could argue that it's a positive for us because we set the price when Bitcoin was at 36,000 and it's much higher today. I care deeply about how Fred and Jaime's companies are trading because everything's a relative value analysis, right? So I'm really happy, like Fred is, that Bitcoin is up significantly since we set that price. And so that's one of the potential downsides. Maybe we're not extracting as much value, or it's slightly more dilutive, having set the value 4 months ago. But on the other hand, when you get back to those 3 fundamental reasons to go public, we want to be like these guys. And so we're perfectly happy.
Well, and I think it would be fair to summarize that wide gap between private and public market capital cost that it is more pronounced for this industry justifies that slight extra cost in the process.
I would say that the gap, well, 1, there's cost, and 2, there's accessibility. Both of these folks I've observed have, in a very intelligent, I think very thoughtful way, used access to capital markets to build their companies. And you're able to make those decisions effectively in a split second to do that. So it's both the ability to access markets when it makes sense to access those markets, as well as cost. It's not just the cost. The only thing I would add on the cost side, and it's come up this morning in the conversations, we are institutionalizing as an industry, but we aren't there fully. And as you know, I've done a little bit in private equity in my career, and the fact is that in classic private markets, there's a big institutional component, okay? And so that normally would bring the cost down some, but we don't have that big institutional component yet fully comfortable with our industry. So that's also a reason for differentiation, right, in the cost of capital.
Amanda, given that you, again, straddle both private and public blockchain or Bitcoin mining companies and have familiarity with both, I'm sure that you're asked for advice, recommendations around what size miners should really think about listing, what kind of installed capacity they should actually have, and to what extent they can look at their forward-looking capacity, order books that they have or may expect or may hope to get on miners, sites that they may think that they're going to develop. It would be great to get some color on to what extent there needs to be real substance, and whether you also maybe have concerns that there are groups coming to the public markets that may lack some of that substance and could dilute the message for those on this stage who have that real substance behind them.
Yeah, so at Galaxy, we have 5 business lines, right? So I'm able to see a lot into the public and the private market. We have people approach us, hey, we want to go public. Can we work with your investment banking team? Hey, we're a private miner. Can we work with you on treasury management strategies with your trading and lending team? And then conveniently, Galaxy is also a publicly traded company, so we kind of fit into that bucket, but not pure play mining like everyone else. So we have a very unique view into the industry of Bitcoin mining. It's all over the place, Zach. I think, we have people that come to us that say, hey, I need money for machines and I'm gonna go public immediately. And you're like, okay, all right, how are you gonna do that? What's the value? And then you have people that have, substantial operations that have been doing it for a while that want access to the public market like Core and everything in between. And so I think, now there's a lot more public mining companies that exist, and you have to have some type of edge, right? Or you have to have some type of operation. I don't think at this point the market will value just purchasing, machines and then saying we're going to do these things. I think a year ago that could have been something that worked, and I think that now you have to have something stood up, right? Because the market is the trajectory is taking off. And so I think it's been a really interesting year for mining specifically, because you see a lot of people trying to almost ape into it without the background that they need in order to go public or to be taken seriously.
Well, I can certainly say that I see decks every other day that love to use people like Fred and Jaime as comps and say, oh, this is why our 2022 forecasts of all these machines we think we're going to get
and
make
then
us
you look at their model and
billion-dollar company, without a single miner installed.
Yep, exactly. And you look at their model and you're like, okay, let's be intellectually honest and see how it works. And you look at their model and they're modeling out 80 exahash and 100K Bitcoin, and you're like, this isn't how this is going to work, right? If we think about the rise and growth of public mining companies, that's something that we also track. And for this year alone, the public mining companies have announced that they will put on 80 more exahash of hash rate coming to the network by the end of this year, just from public company announcements. So we're going to see, a rise in hash rate. We're going to see, I think, hopefully, a rise in Bitcoin price. And I think that we will beat out some of, the groups that they see it as a way to get in, but it might be a little too late. The great thing about mining is, and I think that this is why it's valuable also to investors, is it's the space where the physical world meets the digital world. And so you can't just buy the coin, right? You have to know how to operate it correctly. And so the ones that have done that and have figured out a strategy for that will be the ones that I think the public market will applaud longer term.
We've seen a significant preference for miners in your source of income is obviously Bitcoin, and where many companies would finance their operations growth with some utilization of their retained earnings. We've seen a preference to dilute investors, go tap the capital markets and grow. what is driving that decision? I think, Hade, you're the perfect person to discuss this. What's driving the decision? What is the tipping point at which you start thinking about whether you'd sell Bitcoin, or is there a tipping point when you'd sell Bitcoin to finance the business rather than financing through capital markets?
Certainly, this was a conversation that I had much more frequently earlier in my tenure. When we made the decision and announced that I didn't intend to sell Bitcoin from the beginning of January. But now the investor sentiment has very strongly moved in favor of us holding, and investors are incredibly vocal that they do not want us selling our Bitcoin, and that the Bitcoin held on our balance sheet is part of their investment thesis in coming to us in the first place. So unless that investor sentiment shifts, I think it's here to stay, and certainly the rest of the publicly traded miners have followed suit, and I think it is driven by more investor education. I also think the reality is we see Bitcoin as a very, very scarce asset. Our mining operations, as Fred kind of gave you the math, what we're going to be able to yield as miners is going to continuously go down, and much faster than I think any of us really anticipate. And so the value, what we are chasing, is Bitcoin, and the Bitcoin that we've mined to date is the most valuable and the most Bitcoin that we'll never be able to mine that much Bitcoin again.
If I can add one thing, I think that miners also, like a few years ago, didn't have the same access to products that they have today. So you have companies that are doing things like Bitcoin-backed loans, where you can loan out your Bitcoin and you don't actually have to liquidate it, right? So you still can hold that Bitcoin and get access to capital. You have yield products that companies create that
I have one from Amanda.
that allow miners to hold their Bitcoin. So I think now there's more financial services for miners allowed and available. So miners have optionality, whereas 4 years ago they didn't really have that much optionality.
Yeah. I mean, as an example, we just got a $100 million line backed only by Bitcoin at low single-digit numbers for interest. Bitcoin goes up by 10%. Why would I sell it?
So, final question, as we're running out of time, and a concern that many players, particularly those who are maybe the OGs of on the Bitcoin side, have raised, and we've highlighted here, mining is a capital-intensive business. You need access to capital markets. You don't want to sell your Bitcoin. Not selling your Bitcoin has been a very good strategy historically, and will probably continue to be a good strategy. Capital markets, NASDAQ is a clear leader, and the US is a clear leader, but that's bringing, obviously miners not only play an important role in creating, minting Bitcoin, but also in validating transactions. Now, what is the risk that too much mining capacity and too much validation capacity then comes under the purview of US regulators and the SEC? Does that potentially have a risk for what is so important about Bitcoin? If I could maybe go down the line, starting with Mike.
We've certainly heard conflicting thoughts on regulation. I'm in the camp that of a couple of things that were espoused this morning. One, in the U.S. at least, if they want to regulate it and tax it, they want it to survive. Right? So first and foremost, we want our industry to survive and to thrive. And in that regard, creating regulations that are rational and thoughtful, but that define how we can operate, are probably going to be very useful, and in fact should prove a boost to our industry and our ability to operate. Second, as we've talked about, this is a global industry. Nobody dominates. I mean, sitting on this stage, certainly we represent a good percentage of the global hash rate, but it isn't 20% of it sitting on this stage, and we're all as big as anybody. in the business. So it's marvelously decentralized. Do think that, in fact, more of the mining or processing activity is going to be moving to the United States. But that said, it's also going to be elsewhere on the globe, and we see that coming as well. So I'm not concerned about that now.
Yeah, I think the U.S. So if we go before China, the China shutdown, China represented arguably 50% of the global hash rate. Everybody was, in the US, the regulators were scared about that. Now that that threat is gone, I think if 75% of the global hash rate were in the US, and I'm not saying it should be, but the regulators I don't think would have an issue with that. It's not something they worry about. The industry would worry about it, and I think that what we're going to see is that the people with the largest incentive to be in this business are the power companies. The vast majority of the input cost to mining Bitcoin is power. The power companies, especially people with excess power, and let's look at the U.S. for example. 4 terawatts of power day in and day out for 2 decades. Hasn't gone up, hasn't really gone down, and there's excess power in the U.S. If you then start adding more renewable, and Bitcoin mining is by far the single largest incentive for renewable energy deployment, then you get to a point where all of a sudden every power company in the world is looking at, well, if I boost my production by 10%, it might cost me 2%. I should be in the Bitcoin mining business. All of which is going to drive a large increase in global hash rate, which at the end of the day is going to normalize this business at a 30 to 40% margin business. But it'll be global.
I agree with everything you both said. I would say, miners chase the lowest cost of electricity, and like Fred said, a whole country turned off Bitcoin mining, and the network didn't change at all, right? It just kept going. So I'm not worried about like the decentralization of the network. I think it's there. I think that we're seeing more people flow into the U.S. From different places because of that access to energy, that abundant energy and excess energy. I think mining will always be distributed, though. We have, there's chunks of it everywhere, but the greatest thing about mining is you have no idea where it all is, right? So that's like the value out of it. It is a truly decentralized network.
Yeah, I don't disagree with anybody, or anything anyone has said, and I would just add, like, El Salvador is now mining Bitcoin using volcanic energy. I think we're in the very, very early stages of the innovation that we are going to see globally around mining, and everybody will be participating.
Now, I can see that you've given me 3 minutes and 56 seconds more on the clock. Do we have time for a question from the audience?
Yes, I think so. Since that's just popped up, we can have time for one question.
Thank you very much. Alex Johnston, Northern Data. Just to Fred's point there at the end, would the panelists agree that public mining companies should be the first point of call for anyone seeking to build a solar power or wind power station at this point when they are looking for a load off-taker for a term 10 years plus, just like any other data center operator?
I would love to take that call.
Yeah, I think and these are conversations we're having today. So every single renewable energy developer today is looking at the fact that you can build a renewable energy facility, mine Bitcoin, essentially raise financing for that facility because of the mining of Bitcoin, and then eventually the transmission lines that will connect you to retail customers will be built. More importantly, though, what we're now seeing instead is completely isolated renewable energy systems being built where the only purpose is to mine Bitcoin and generate hydrogen. Why hydrogen? Because it lets you run the Bitcoin mine 24/7. And so you take a solar facility, you run it 50% of the time for mining Bitcoin, 50% for electrical cracking, if you would, of water into hydrogen that lets you run your hydrogen turbines when the sun's not shining. And these facilities have no connection to any consumers at all. The only reason they're there is to generate Bitcoin. And we're going to see 10 gigawatts of that come online over the next 4 to 5 years, most probably.